If you want to know everything about multi-member LLC taxed as S-corp, here is the overview for you. The big question is, can an LLC be taxed as an S-corporation? Yes, provided that you file the proper form with the IRS. So let's talk about the types of LLCs first, because it's really important to understand what the kind of distinction you need to think about when thinking about LLCs in general. A member of an LLC is similar to a shareholder in a corporation. With respect to members, there are two types of limited liability companies. So we have a single member LLC. So this is an LLC with only one member who is the sole owner of the business. And then you have a multi-member LLC. So this has two or more members. And basically, members can share equally in the profit or loss of the business, or can share in different proportions as determined by the LLC operating agreement. This is an important document for another conversation, but we have this is really important. Now let's talk about how does a single member LLC file taxes. The thing here is that if your LLC is taxed like a sole proprietorship, you will report the LLC profit or loss on your individual Form 1040, along with either Schedule C, profit or loss from business, Schedule SE, supplemental income or loss, or Schedule F, profit or loss from farming, depending on the which schedule is appropriate for your type of business. And the thing is that the only reason why you do this is because the IRS treats you by default as a disregarded entity. And so basically you're kind of similar to a sole proprietorship in the eyes of the IRS. So the LLC itself pays no tax, but the profit or loss will be reported by you on your individual Form 1040, along with Schedule K1 Form 1120S. Shareholders' share of income, deductions, credits. You will need to pay taxes on any profit, regardless of whether the LLC actually passes it on to you. Now, how does a multi-member LLC file taxes? For a multi-member LLC taxed as a partnership, the LLC will file Form 1065, Return of Partnership Income, which shows the share of the profit or loss that is attributed to each LLC member. Each member then reports his or her share of the profit or loss on his or her individual Form 1040, along with Schedule K 1065. If the multi-member LLC has elected to be taxed as an S-corporation, the LLC itself will file Form 1120S, which shows the share of the profit or loss attributed to each member. The LLC itself pays no tax, but each member must report his or her share of the profit or loss on his or her individual Form 1040, along with Schedule K1 Form 1120S. And each member pays taxes on their share of profits, regardless of whether the LLC actually passes on the profits to the members. Now let's talk about why you might choose S-corporation taxation for your LLC. By the way, welcome back to the show. Really appreciate it. We are having a nice conversation today about multi-member LLC taxed as S-corporation. Now, so what really can cause an entrepreneur to actually choose S-corporation taxation for their LLC? Now, electing to be taxed as an S-corporation can have tax advantages, especially with the new pass-through tax deduction created by Tax Cuts and Jobs Act, the TCJA. A multi-owner LLC is automatically taxed as a partnership by default, while an LLC with one owner is taxed like a sole proprietorship. That's what I'll talk about, disregarded entity. Again, those are by default. However, LLCs may choose to be taxed as a C corporation or S corporation by filing a document called an election with the IRS. So when you do this, you are electing to be taxed as an S corporation. So once this is done, as far as the IRS is concerned, the LLC is the same as a corporation and it files the same tax forms as a corporation. Most LLCs, they actually stick with their default form of taxation. So why choose an S corporation then? Because electing to be taxed as an S corporation can have tax perks. This is especially true as a result of the TCJA. Now, what is basically the S corporation? Now, it's not really a type of legal entity like an LLC or corporation that you form at the state level. Instead, an S corp is essentially a tax status recognized by the IRS. LLCs and some corporations can elect S corporation tax status by filing paperwork with the IRS. Now, let's talk about how an LLC is taxed. if an LLC is taxed as an S corporation, how does the whole thing work? Like a partnership, an S corporation is a pass-through entity, right? In other words, income and losses pass through the corporation to its owners' personal tax returns. S corporations also report their income and deductions, much like partnerships. An S corporation files an information return, Form 1120-S, reporting the corporation's income, deductions, profit, losses, and tax credits for the year. S-corp owners must provide shareholders a Schedule K-1 listing their shares of the items on the corporation's Form 1120-S. The shareholders file Schedule E with their personal tax returns, showing their share of corporate income or losses. Now let's talk about the employment status of business owners. By the way, I just want to quickly remind everybody of today's topic. We're having a conversation about multi-member LLC taxed as an S corporation. So let's talk about the employment status of business owners. So where S corporations really differ from partnerships is the employment status of owners who work in the business. The owner of an LLC taxed as a partnership is not an employee of the LLC for tax purposes, because he or she is simply a business owner. So it's really important to keep this distinction in mind. In contrast, an S corporation owner who performs more than minor services for the corporation will be its employee for tax purposes, as well as an owner. In effect, an active owner in an S corporation wears at least two hats: as a shareholder, in other words, owner of the entity, and as an employee of that entity. And so basically what happens here is that the Social Security and Medicare tax rate for an employee is the same as for a self-employed business owner. However, it's paid differently. Let me break it down for you. So half the total tax is deducted by the employer from the employee's pay, and half is paid by the employer itself. When you own the business that is paying these taxes, it makes no practical difference that half is paid by the employer, because you are the employer. And so the IRS pays attention to something called reasonable salary requirements. So an owner employee must be compensated for his or her services with a reasonable salary and any other employee compensation the corporation wants to provide. The owner employee must report an S corporation's earnings on his or her personal income tax return and pay his or her share of Social Security. We have Social Security, we have Medicare taxes on any employee salary paid. So the corporation must withhold federal income and employment tax from the owner employee's pay and pay state and federal unemployment taxes and Social Security and Medicare taxes on the employee's behalf. So why would an LLC basically file as an S-corp? Well, because of the tax treatment. That's the bottom line here. Because being classified as an S corporation employee has a potentially big advantage. S corporation tax treatment can provide a way to take some money out of your business without paying employment taxes. This is because you don't have to pay employment tax on distributions, dividends from your S corporation, that is, on earnings and profits that pass through the corporation to you as an owner, not as an employee in compensation for your services. So the larger your distribution, the less employment tax you will pay. And the S corporation is the only business form that makes it possible for its owners to save on Social Security and Medicare taxes. And historically, this has been the main reason S corporations have become very popular. Let me dig a little deeper here, because I think this is really important to understand clearly. One thing I want to say here is that, and I want you, this is an important element, an LLC offers limited liability and flexibility. So it's important to understand that an LLC is always it's great already. So if you are a multi-member LLC, you can choose to remain an LLC. But for tax purposes, you just want to actually adjust your situation to maybe an S corporation if that will be better for you. Again, it all depends on your objectives. It depends on the kind of strategy you have for your tax planning, and so on and so forth. It also depends on the goals that each member of the LLC has agreed on. Okay, so when we talk about the most significant features of an LLC, we're talking about limited liability for owners, pass-through of income to owners, avoiding double taxation unless C corporation tax treatment is elected. You have ease of operation, so you have fewer formal meetings and record-keeping requirements. You have fewer profit-sharing restrictions, so earnings are distributed as members see fit, not based on the percentage of capital contributions, although there are restrictions if S-corporation taxation is chosen. Entire net earnings of an LLC pass through to owners in the form of self-employment income, subject to 15.3% SICA tax. So that's self-employment tax for Social Security and Medicare. Okay, and so basically there is no taxation. There's no taxation. So by default, an LLC with one member is actually a disregarded entity, and a multi-member LLC will have to file Form 1065 if it chooses to be a partnership, or Form 1120S if it chooses S corporation. But there is no payment of taxes at the company level. That's why it's called a informational return. So 1120S or 1065, those are called information return. Basically, you're telling the IRS, hey, listen, here is how much we have made this year, and here is how much we have actually distributed to our owners. So the IRS will actually will cross-check the data you sent to them to the data that your individual members have sent to the agency, to make sure that everybody is playing a fair game. Now let's talk about combining the benefits of the LLC entity and the S corporation tax treatment. By the way, I want to quickly remind everybody of today's topic. We're having a conversation about multi-member LLC taxed as S corporation. So if you think you can benefit, basically, from the combined features of using an LLC to own and operate your small business, and then having it be taxed like an S corporation, the possibility really exists to establish your business as an LLC. You probably heard a few minutes ago that I spoke about all the benefits, the constellation of benefits that actually pertain to an LLC. Okay, but you actually just make sure that you make the election to have the LLC treated as an S corporation by the IRS, okay, for tax purposes. You'll have to make the special election with the IRS using a form called 2553. We have covered this form on several other shows, so if you're interested in that, please let us know. We'll just send you the link to those videos. You can just watch them. And so here are some things you have to remember. From a legal standpoint, your enterprise will be an LLC instead of a corporation. Therefore, you will have the benefit of ease of administration, fewer formal meetings, and record-keeping requirements. Okay, this is really good. From a tax perspective, though, your enterprise will be treated as an S corporation. You will still have the pass-through of income, avoiding double taxation, same as if your LLC was treated as a proprietorship or partnership. And the business, in other words, your LLC, can pay wages and salaries to you or to other owners. This amount will be subject to FICA tax and other withholding requirements, but then it can distribute the remaining net earnings to you and the other owners as passive dividend income, not subject to SICA tax. This is really good. So being treated as an S corporation may provide opportunities for tax planning to minimize the overall tax liability for your business and you. So obviously this is important. You need to carefully consider the pros and cons of different forms of business organizations and the different ways these organizations can be taxed. So seeking professional advice this video is for information only. Obviously, we have CPAs and EAs and tax attorneys in our team, but this video should be construed purely as informational. We are providing information to you, but if you want specific advice concerning your specific situation, please seek professional advice. And this can come from a CPA, an enrolled agent, or a tax attorney. Okay, this is always getting this type of expertise is always great practice when making choices that can affect your life or your business for many years to come. Let's talk about pass-through tax deductions. And this is really important, especially I want to really have a conversation about limitations on the pass-through deductions. And the thing is that the TCJA established a brand new tax deduction And this is basically for businesses owned through pass-through entities. So we're having a conversation about sole proprietorships, partnerships, LLCs, and S corporations. So starting in 2018, owners of such entities may deduct up to 20% of their net business income from their income taxes. So this is a personal deduction all pass-through business owners may take whether or not they itemize. And the thing here is that there are some limitations, okay? So you can qualify for the 20% deduction only if your taxable income for the year is less than about $160,000 if you're single, or $320,000 if you're married filing jointly. If your taxable income is greater than about $210,000 single, or $420,000 married, you don't qualify for the pass-through deduction unless your business pays employee wages or has business property. In this event, there are some special calculations in place. They may be too complicated to explain here. If you want, please if you have a question, let us know. We'll certainly help you out. And there is a pass-through deduction for personal service business. Unfortunately, the rules are not always the same across the board. So basically, you're going to have to actually have a different strategy if you are in certain personal service businesses, such as accounting, law, health, consulting, athletics, financial services, and brokerage services. Okay. Now, the pass-through deductions is not available for such businesses where the owner's taxable income is over $420,000 for married individuals or $210,000 for singles. One thing I want to say here is that it's always good to actually have a conversation with the CPA, an EA, or a tax attorney, because then you can discuss the very specifics of your situation, because tax laws change all the time, and the rules are always adjustable. I mean, you can always find a way to comply with the law, but also make sure that this is amenable, quote unquote, amenable to your tax situation. In other words, you can use the law to your advantage to reduce your tax liability, of course, within legal boundaries. Okay, so those are really important, but please, you need to have the help of an expert to kind of help you out. Now let's go to this conversation by actually explaining how you need to elect S corporation status. And so no business entity starts out with the S corporation form of taxation. And I think I made it very clear that basically at the state level, there is no such a thing as I want to file an S corporation. I want to incorporate. You can, if you want to form a business, you can register as an LLC, an LP, an LLP, an LP, a C corporation, but as a partnership, but not as an S corporation. This is something that only the IRS owns. Okay, so if you want to actually get this status, you actually need to obtain it by filing what I just said, Form 2553 with the IRS. So this form is quite essential. I mean, everything starts with this form. It's called election by a small business corporation. However, your business may qualify for S corporation status only if your entity has no more than 100 shareholders. None of your company's shareholders are non-resident aliens, that is, non-citizens who don't live in the United States. Your entity has only one class of stock. For example, there cannot be preferred stock giving some shareholders special rights. And none of your company's shareholders are other corporations or partnerships. So those requirements pose no problem for most small businesses. If you want S corporation status to apply to the entire calendar year, you must file Form 2553 by March 15th. The filing is retroactive to January 1st. And again, one thing I want to say very clearly here is that you want to make sure that you actually have paperwork, because S corporation status actually entails a constellation of documents, not only when you file it, but also if you want to maintain it. In other words, the IRS is really strict about the S corporation requirements. So if they audit your business and they realize that you're not actually keeping proper documentation, your bookkeeping is not really effective, they might actually revoke that S corporation status. Thank you so much for your attention. I really appreciate it. In today's conversation, I was just talking to you about multi-member LLC taxed as S-corporation. So we spoke about the types of LLCs. We spoke about why you might choose S-corporation taxation for your LLC, how an LLC is taxed, how the whole thing works. We dug a little deeper, and we talked about pass-through tax deduction and how to actually elect S-corporation status. Thank you so much. I'll see you another time, but until then, remember, stay marvelous.